How much will UK regulation change now that Brexit is done? What kind of powers do UK regulators have? And what can financial services firms expect to see next? With the close of 2020, the UK reached the end of the transition period for exiting the European Union and the EU's single market for financial services. Now, in 2021, the UK financial regulatory framework is still very close to the EU, but there's more of an opportunity for regulators to independently make changes than perhaps ever before. I'm Scott Martin from Deloitte Centre for Regulatory Strategy, and you're listening to Regulated Radio. I'm really pleased to have Andrew Bulley, Henry Jupe, and Felix Bungay on the show today for our latest Working From Home podcast. We'll be digging into the topic of EU-UK regulatory divergence and using the insurance sector as an example of the kind of changes we may be likely to see, what major regulatory initiatives are coming up on both sides of the channel, and how we think insurers can anticipate a more complex regulatory landscape. Now, this is a big show with a lot to discuss, so let's jump right in. This is Regulated Radio. What the UK's departure from the EU will mean for financial services regulation is a topic that could fill a whole podcast series. In December, we spoke to our banking and capital markets team about how banks were making last-minute preparations for Brexit, and now we wanted to look ahead. We thought that there was no better place to begin than with the insurance sector. And as you'll hear on the show today, upcoming work like the review of the Solvency II regulation means that insurance might be one of the first areas where we see meaningful regulatory divergence between these two jurisdictions. So, as mentioned at the top, I'm delighted to have Andrew Bulley back on the podcast to get us started. Frequent listeners to Regulated Radio will know that Andrew is the partner leading the insurance practice at Deloitte Centre for Regulatory Strategy. Andrew, it's good to have you back as always.
Oh, thank you, Scott. Good to be back.
So, Andrew, since the UK is now past the transition period for exiting the European Union, I think it's fair to say that it's now an independent jurisdiction from a regulatory point of view. Given this, do you think we're going to see a wave of deregulation in financial services?
So thank you, Scott. So it's a big question. And I think it depends ultimately on what we understand by this phrase deregulation. It's quite an emotive phrase, and a lot of people associate it with sort of bonfires of regulation, bonfires of control, that sort of thing. I mean, I think emphatically that's not where the UK is. Certainly, and perhaps predictably, that's certainly not where the regulators are, but nor I think is it where mainstream political opinion is either. And I think sort of the key point is that deregulation is not to be equated with reduced standards of regulatory protection. One does not necessarily lead to the other. From the UK perspective, the UK has been at the forefront of promoting strong regulatory standards at a global level. And indeed, it's sometimes been criticised, rightly or wrongly, for alleged gold plating of EU directives and requirements. And we're going to be discussing Solvency II later on. I think, let's not forget that the UK designed and advocated much of what is currently in Solvency II, particularly the market consistent element of it, the 99.5% protection at a capital level, and the whole use of internal models. So I think overall, in answer to your question about waves of potential deregulation, it's really important to understand the different contexts and traditions between the UK and the EU in the regulatory sphere. Now, there's no doubt the EU does have an orientation towards highly detailed prescriptive rules. And I say that neutrally. It's not just a result of their legal and administrative traditions, but also I think the challenge the EU has faced of corralling many, many different markets and jurisdictions into a single framework often aimed, as with Solvency II, at maximum harmonisation. The UK has preferred more what we might call outcomes-led judgmental supervision, obviously proceeding within a broad framework of rules and principles. And it's for that reason we think that in some ways the insurance regime to come may well come to resemble its predecessor regime, known as the ICAS regime, and perhaps be more consistent with that currently operative in the banking sector. So in a nutshell, I think this wave of deregulation, to the extent it materializes, will take the form of moving towards a more judgment-led, pragmatic approach focused on outcomes rather than tight mechanistic adherence to relatively micro detailed rules. And I think the prize to be gained in all this is a more agile, efficient regime for both regulators and regulated alike.
Thanks a lot for that, Andrew. Now, for the first part of the show, I'd like to turn to Felix Bungay. Felix is a senior manager in the Center for Regulatory Strategy, and he's been focusing recently on how the UK regulatory framework could change in a post-Brexit world. Felix, welcome to Regulated Radio.
Hi, Scott. Great to be here.
So, Felix, I just wanted to follow up on what Andrew was saying about regulatory divergence. I know this is something you've been looking at recently, so I'm wondering, why are differences in the regulatory approaches between different jurisdictions something that people or firms should pay attention to?
Thanks, Scott. So I think first and foremost, firms should be paying attention to this because it can mean that they end up having to comply with quite different sets of rules across the UK and EU. And essentially that means that they'll have to change the way they look at things, make sure they're complying with the local regulatory obligations upon them, and change their approaches to compliance. So to give an example, the EU might revisit its approach to a particular bit of legislation. The UK might decide not to review that bit of legislation. And that means that over time, the UK's rulebook and the EU's rulebook will end up looking a bit different, and firms will have to be live to that and take that on board. I think even where we don't see rule changes, though, we may see the UK and EU taking a different approach because they have different underlying philosophies guiding their way of thinking. And that may, bleed through to supervision as well, and supervisors emphasizing different bits of the rulebook or different bits of guidance. And firms should be alive to that as well.
But how would you say we see regulatory divergence come about in practice? And I guess what I mean is, does it mean that written rules need to be materially different between key jurisdictions, or can it maybe sometimes be a bit more nuanced than that?
So I certainly think it can be more nuanced than that, although certainly changes to the written rules and to the rule books in the respective countries is important. And, let's take that first of all. So, here in the UK, the government has kicked off a number of regulatory reviews looking at different regulations. So it's looking at Solvency II, which I'm sure we'll come on to. It's also looking at PRIPS, changes to the UK listings regime. There are a number of other things as well. But here, the government's kind of reviewing some of the existing EU rules, and we might see rule changes here in the UK. And indeed, looking forward, the UK might decide to legislate on a particular area of financial services, the EU may not, or vice versa. And so all of that obviously is quite important. But more than that, we might see a different approach here in the UK. So as I think Andrew has said, the UK has often taken a more judgment-based approach to regulation versus the EU's more prescriptive and rule-based approach. And that can lead to differences in emphasis, a different relationship between the regulator and the regulated firms here in the UK, and firms here in the UK having to be more alive to what exactly the messages that the regulators are putting out, and to rely upon the judgment of those regulators ultimately. So there's quite a difference there.
Now, Felix, there's obviously a lot of discussion about what the UK does now that has left the EU's regulatory jurisdiction. What would you say is the driving philosophy behind the UK's regulatory actions?
So there's a number of different things that I think drive the UK's approach. I think, firstly, there is a very strong commitment to international regulatory standards, and the UK, both when it was a member of the EU and now that it's left, has signalled its strong intent to continue to abide by the key international sort of decision-making, to play a full part in determining the kind of international and global sets of rules, which of course will continue to be implemented in the UK. So I think the UK is a strong champion of global standards and will be wanting to comply perhaps in a strict manner with those standards, or what most people would see as a strict manner with those standards. One of the other things we've also heard from UK regulators is the phrase same standards but lower burden, which means that the UK won't be rushing to have this bonfire of regulation, but will be looking at how it can meet the same high regulatory standards but lower the burden on firms. So cutting out unnecessary costs, trying to make things more quick and more efficient, while also ensuring that those robust regulatory standards remain in place and we don't have a race to the bottom.
Thanks a lot, Felix. Now, we said that we would use the insurance sector as a case study for regulatory divergence in this show. So I'd like to turn to one of our insurance sector experts, Henry Jupe. Henry is a director in our Center for Regulatory Strategy and does a lot of work to help insurers navigate the complexity of the changing regulatory requirements that they face. Henry, it's good to have you on the show.
Thanks, Scott. It's great to be here.
So, Henry, we said at the outset that the regulation of the insurance sector, and particularly the Solvency II regulation, is a really good example of where we might see EU-UK reg divergence. Why would you say this is?
Well, as Andrew mentioned earlier, Solvency II is a maximum harmonising directive, and it's therefore designed to be applied consistently across the whole EU market. And the focus of particularly EIOPA and the European regulatory community is around making sure that Solvency II is implemented in a consistent way by different national supervisors. Now, in practice, despite the fact that, again, as Andrew mentioned, the UK was very heavily involved in the design of Solvency II, that has meant that there are some specificities in the UK market where Solvency II does not work so well, and that's particularly the case for the life insurance sector. So the UK is therefore looking at ways that Solvency II can better reflect those specificities, but importantly, while remaining within the overall design of the Solvency II framework.
And if you think about Solvency II in its entirety, what part of the current framework do you think are the most likely candidates for us to eventually see a divergent approach between EU and UK regulators?
I think the highest priorities for the UK are likely to be the risk margin and the matching adjustment. They're both points that the Treasury is looking at as part of its call for evidence on Solvency II, and the PRA has also looked at extensively. We're likely to see a risk margin, I think, that will allow more use of complex modelled approaches, particularly for insurers writing very long duration business, and also a matching adjustment that reduces the need for complex securitization structures for certain assets, such as equity release mortgages, to be included in matching adjustment portfolios. That's something that insurers in the UK have done in order to work with the current Solvency II framework, but I think there may be a move towards perhaps simplifying some of those requirements to avoid the need for that extra layer of complexity. The PRA is also likely to look at the Solvency II reporting requirements, which are very extensive for Solvency II, and again looking to tailor those more specifically to the UK market and therefore reduce the burden of reporting for insurers in the UK.
Now, Henry, you've worked with insurers for a long time, and can you give me a sense from that of how challenging it is for them to manage increasingly different regulatory regimes in the countries that they operate in? And as a follow-up, I'll stick in now, are there maybe ways that this challenge can be better managed going forward?
Well, I think the first thing to say is that divergence in regulation is manageable. And the UK is home to many complex international groups, and they are very used to the challenge of managing different regulatory regimes. Clearly, many parts of the UK insurance sector are active in many countries around the world, for example, markets in Asia. And therefore, as I said, managing those different regulatory frameworks is something that they're used to doing. I think it's also important to say that for many insurers in the UK, the benefits of divergence could outweigh the costs of managing that divergence. So if the UK changes the insurance regulatory framework to make it more tailored to the specificities of the UK market, then in practice that could provide benefits to the UK sector that would make it well worth managing those different divergent approaches. However, that said, Solvency II is a very computationally complex regime with a great deal of modelling underlying the capital, again particularly for more complex groups. And it's also a very high reporting and disclosure regime, so with extensive reporting to supervisory authorities and to the public, and quite short reporting deadlines. So the systems and data that's needed to manage that can put a heavy burden on systems and data, and therefore, as you add in different cuts of reporting, different detailed rules, etc., then that can compound that systems challenge. So I think the main area in which I would see insurers needing to do work in order to manage future divergence would be systems and data development. But again, as I said, that is something that insurers are also well used to doing.
Thanks a lot, Henry. Andrew, I wanted to turn back to you for the next couple of questions. And of course, we've talked before about how you've spent a large part of your career as a financial supervisor. So I just wanted to ask about something Felix mentioned earlier, that the UK might take a more judgment-based approach in its financial supervision. So I'm wondering, as a former supervisor yourself, what does exercising this kind of judgment actually mean in practice for the way that, say, an insurance firm is regulated?
Thanks, Scott. Yeah, it's a very good question. I mean, I think perhaps the first point to emphasize is that it does require supervisors to be confident, flexible, skillful, and very market alert in terms of responding quickly to what's going on in the market and understanding those trends and analyzing them and reaching the right overall judgments. I mean, the prize in all this is a more risk-based system, which is more efficient both for the regulators, and their resources are always going to be highly constrained, and for the regulated firms. But I mean, let's be clear. In some ways, an outcomes-based regime is tougher for the regulators. You know, there is much less scope to hide behind detailed rules, and they've got to at times justify their stances within a pretty robust accountability framework, such as we have in the UK at the moment, and will no doubt continue. I mean, in many ways, we're asking the regulators to wield more of a scalpel than a one-size-fits-all approach. But the upside is clearly a more nimble, efficient regime. I mean, faster turnaround of the processing of firm requirements and, for example, model change applications, and arguably an ability on the part of the regulators to respond to emerging risks more quickly. So, I mean, that's the upside of the flexibility, but I think there are some quid pro quos that go with that. And I think much of the process burden and the caution of Solvency II arises, and this point's not always fully appreciated, I think, in the market. It arises because of the regulators' hands are quite tightly bound in legal terms by a very, very prescriptive and detailed regime, particularly in the area of model approval. So I think the quid pro quo for greater flexibility, a quicker turnaround, more risk-based judgments, is potentially what we see on the banking side routinely, which is capital add-ons on a precautionary basis, and potentially the application of conditionality on model approval to enable the regulators to mitigate the risks inherent in model approval.
So, Andrew, I just wanted to follow up on one of the points that you made about the judgment-based system being more efficient and nimble. Just tying this back to the topic of regulatory divergence, does this kind of supervisory approach, the one that you're describing now, make it ultimately easier for insurers and other firms to manage the challenge of regulatory divergence?
I think there are pros and cons from the firm's point of view. I mean, I think undoubtedly it could lead to a quicker turnaround system, more streamlining of processes, better application of regulatory resource, and therefore better use of firms' resource in response. But I think equally that there is always going to be, in any sort of judgment-based regime, an element of unpredictability, an element of caution baked into the system. And I think firms will sort of need to adapt to that in terms of recognizing that, to some extent, if the regulator is responding flexibly and taking a judgment, that there may be certain regulatory mitigations, such as precautionary capital add-ons or temporary remedial programs or whatever, prior to the solution being implemented. So I think overall it's a mixed picture from the firm's point of view. There is the upside of increased efficiency. There's the potential downside of some lack of predictability in the system. But overall, I think, comparing the UK's former regime, which was very much the ICAS regime, which was very much a judgment-based outcomes regime, such as we've been discussing today, I think many firms ultimately adapted to that very effectively and found that it worked pretty well, both in fair weather conditions, but also during the financial crisis.
So, Andrew, Henry, I wanted to end the show by asking both of you to think about the regulatory landscape for insurers across the EU and the UK in 5 years' time. And I'm wondering, what in your view are the biggest opportunities that will arise for insurers and regulators from the kind of regulatory change that we're likely to see in that time? Henry, why don't you go first?
Thanks, Scott. So I think if there are changes made to the regulatory framework, and that could be the regulatory framework in the EU or in the UK, because it's important to say there is also the EU Solvency II review underway at the moment, as well as the UK. But if there are changes made to the framework that means it better matches the long-term business model of insurance, then that could allow insurers to take that business model further. For example, giving them more opportunities to use things like investment in long-term assets, such as infrastructure, to match their long-term liabilities.
And Andrew, the last word goes to you.
Thank you, Scott. Well, I agree with what Henry said, really. I mean, I think the key opportunity in all this is to ensure we have a regulatory system that is optimized for the UK market. In other words, that the UK regulators are rule makers rather than partial rule takers or indeed complete rule takers. Now, I mean, I think any country in the EU is at the end of the day a rule taker. That's not in any way to criticize the EU or to downplay the amount of influence the UK was able to exert in the EU. And in practice, the UK was enormously influential in influencing and fashioning many EU regulations, not least in the Solvency II area. But ultimately, the UK, as with any other member country, had to take certain rules and requirements, but it would have preferred not to have done so. And that has led to some significant inefficiencies, and particularly, again, if we use Solvency II as an example, the risk margin and the way matching adjustment has operated, two areas that Henry highlighted earlier, that has led to some very significant inefficiencies. So I think the opportunity for both regulators and firms is to produce a more nimble, agile regime. And that's not just rhetoric. I mean, I think it's the reality of this, a regime that is better attuned to the business models and the needs of UK firms and consumers, and from a pure regulatory perspective, better attuned to the specific risks of the UK market. And finally, a regulatory regime that can be adjusted quickly if design problems or unintended consequences, such as, for instance, the risk margin, as Henry's been describing, if those design problems or unintended consequences suddenly materialise.
Andrew, Henry, Felix, thanks so much for coming on Regulated Radio.
Oh, thanks, Scott. Great pleasure to be here again.
Thank you, Scott.
Thanks, Scott.
And there you have it, potentially a much more complex regulatory landscape for insurers in the EU and the UK to contend with going forward. Now, I hope you're all well in these chilly winter months. Here at Regulated Radio, we're busy putting together a pipeline of great guests and topics for upcoming shows this spring, but there's still room for ideas. So if you have any or would like to share your thoughts with us, just drop us a message at regulatedradio@deloitte.co.uk. We would love to hear from you. And remember, if you like the show, hit the subscribe button to ensure you receive notifications about our next episodes. And if you're already subscribed, you can give us a review on wherever you get your podcasts. But that's all for now. Thanks so much for joining us, and you'll hear from us again soon.